dedicate yourself to your new career in an unlimited way, unrestrained way, like you did when you first came out of the university at age 21. So this is exactly what I'm doing. I have put in my first 10,000, actually already 11,000 hours into my second career, venture capital. So based on that, I can be described as an expert. Another 11,000 hours, and I will actually mean something in this industry. It was time to change. Throughout my financial career, my clients industry, primarily my clients were technology and telecommunications. So I fell in love with people who either create new technology or deploy it in a fast way.
Yeah.
Fell in love with people who make new technology and new things. And I really found this niche of fast-growing technology companies and venture capital firms who support them and who make it possible. And one 6-month thinking period, I made the change and joined a group of people to do this. And my partner and I today are the two people from that group. And we have narrowed down what we do to Viaduct Ventures, a Series A early stage California technology venture fund.
Cool. So you are now an advisor to technology companies, or you were also during your time at EY, I believe, an advisor to technology companies from early stages to IPO. And you specialize in growth of the business, corporate governance, building successful, scalable startup business models. Tell us a little bit about how you do this and what is your criteria when looking and taking these businesses apart.
A few words a little bit about the stage at which we invest and where we find our portfolio companies. We invest at the so-called Series A stage is the stage where usually a technology startup has started monthly recurring revenues, which means the technology is done, the product is done, the market distribution channels, at least one or two of them are there, and now the company is trying to actually bring this product to the market and start regular sales revenue activity. So we are, Series A is the first round, which is a growth money. The money that we, together with our co-investors, bring into the company goes primarily into distribution and growing of sales. Marketing, hiring salespeople inside the company, obtaining new sales channels, and basically kicking off the hockey stick growth of revenues that is required or understood for a California startup. So from that standpoint, it's actually over the past 5-6 years, this area, Series A, Series C, has emerged as a death valley for early stage technology startups, not just California, everywhere in the world. There's lots of angel investors, friends, parents, who are able and happy to finance the company to the point where technology is done and the product is in the market. There's a lot of bubble money everywhere in the world, including in the United States, who are happy to make $100 million rounds, $300 million rounds, and as in the case of Uber, billion-dollar rounds. But it's exactly when you've already proven out your business model and the revenue is there. But it's exactly that moment, that 1 or 1.5 years, where you're taking one-off proof of concept revenues and turning them into regular normal revenues, where you're taking your technology invention company and making it a commercial company. That's exactly the stage where the highest risk is and where professional investors are very, very careful and risk averse in terms of investing it. And that's where we come in. And so from that standpoint, the two biggest needs of the startup at that point of time is selling and scaling. We cannot help with that. We can help find people who can help doing that. And the other largest need is prepare for the next round of venture financing. Build out the corporate governance, create the board of advisors, clean the cap table, clean up the explanation of what the company does, how it makes money, the cap table and the waterfall analysis, what the next investors in the next round will be facing when they invest in the company. And then, of course, actually create the terms for the next round, bring in investors in the next round, and make terms as favorable as possible to the existing shareholders. That part, corporate finance, corporate governance, is what we do. We usually insist that we are either members of the board or at least non-voting members of the board. So we work fairly, at least once a week, so fairly regularly with every one of our portfolio companies in order to build their scale and in order to prepare for their next round of financing.
So what are the biggest issues that tech startups face, and how do you help them avoid these pitfalls or overcome them? Hold your mic a bit closer when you speak.
Understand. How about this?
I can hear you better now.
Right. Those are not pitfalls. The venture industry is 55 years old. All of the statistics have been done, all of the textbooks have been written, and all of the memoirs of early starters have been published. And so this is not a new industry. Everybody knows what the pitfalls are. It's all in the textbooks. The issues, call them, that startups are facing, the number one issue is the point where a cool new technology or a cool new science needs to get narrowed down, made into a product that you can describe in a contract, that you can attach a price to and sell it to a customer or a corporate customer and get them to confirm that they need this product by paying you. That is the biggest problem. The vast majority of early stage startups do not survive that stage. Okay. We do not deal with that problem. We invest only after that problem has been solved. The second biggest problem that startup face is the stage that I just described. You do have the product, you do have the first one-off revenue, you have interested clients, sometimes clients with amazing names. Google and Walmart and SAP and DHL are interested in our product. It's very easy to go down the round of one-off R&D of proof of concept revenues and fall in love with your clients. And then once the proof of concept stage ends, you are left with no future and no runway in terms of money. That is exactly the point where you need to be somewhat selfish or ruthless with your clients and say, clients, we love you. We cannot jump to your every whim. You need to subscribe to a monthly or quarterly fee, and we need to turn this into a recurring commercial business. Sometimes founders are too timid and just miss this point. Sometimes founders cannot negotiate this properly because the corporations have all the power. So a lot of startups fail, even though they already have one-off revenues, sometimes in the millions of dollars. What happens is, because it's not recurring revenue, they're not able to raise the next round of financing, and then at one point of time, they have to either sell the business for a pittance or just completely close the doors and lose the 4, 5, 6 years of your life for no return. The second problem is the one where we help. If you describe this time of the life of the startup as the valley of death, then you could describe us as sitting at the end of the valley of death and reaching into it and pulling you out. We will not go into the valley of death with you, but the ones that are close, we will reach out and pull you out into the space where there are revenues and willing financiers to provide you more and more revenue growth.
So you've talked a little bit about why venture capital, but when do you think companies are really ready to access venture capital? And what does it all kind of mean?
Well, if you look at...
Keep it close. Very strict.
Well, if you look at, it's again, the textbooks are there, the blogs of famous venture investments are there. Revenue is by far more important than equity financing or debt financing. Mm-hmm. If your revenue is growing on a hockey stick curve already, then venture capitalists will actually call you.
Okay.
So the key focus, revenue is sustainable. It's a payment that you keep. And if it's recurring revenue, it's a payment that you keep. And you have a very high chance that next month this revenue will come again, and next month it will come again. From that point, everybody loves that. You love it. Your early employees, who are probably working for a smaller salary and the promise of future stock options, love that. And outside, existing shareholders, existing investors like that, and future investors like that too. So demonstrate the first revenue, demonstrate the first recurring revenue. If you cannot do it alone, then use angel investors, people who you know, people who are here. I understand there's quite an infrastructure of individual angel investors here in Gibraltar. Mm-hmm. And once there's the first recurring revenue traction and maybe a good logo cloud, like very interesting names that are on your client list, that's the time when you go for a professional venture round. And the use of proceeds from this round should not be more technology, should not be more programming. It should be rolling out the sales organization, selling more, and growing your revenue.
So what are the types of startups that you would look at as the managing director of Viaduct Ventures, but you're also managing director of another, or have been, of another seed fund called Launch Gurus?
So it's a family. We are an asset management company that manages a family of funds. All the funds do approximately the same. Our industry focus currently is artificial intelligence, machine learning, and IoT. Everything that has to do with massive amounts of data and artificial intelligence that helps figure out the meaning of the data and allows the customers, large US enterprises, to use it to increase their financial performance. Preferably increase their revenue streams, if not, then significantly decrease their cost base. The reason we're focusing on artificial intelligence right now is exactly like I was saying before. Generally, the technology of artificial intelligence is done. In the lab, it works perfectly, everything is done. Now is the time to take the technology out of the lab and out of the university audience and figure out ways to use it commercially for the largest enterprises of the world. And once you found a way to use it commercially, show a little bit of revenue growth and exit to those same enterprises for life-changing amounts of money. That's exactly what we do. There are other industries there. There are, of course, other geographical locations other than California out there. We're trying to stay focused, and there's such a good pipeline in artificial intelligence in California that we're just focusing on that and growing our portfolio from that.
So when we spoke on our initial call, you gave me some very interesting figures, and I'd like to share those because what I found interesting is the amount of startups you look at and the amount of startups you end up supporting or taking through the process. How many of those have got rounds of funding and the successful exits? So can you just talk us through those figures? Because I thought that was super interesting.
Okay. Statistically in the United States, 1 out of 10 startups that obtained or raised venture financing will get to an exit. Or to be more specific, 8 out of 10 will shut down and the investors lose the money and the founders will lose their money completely. 1 will grow on a slow scale and return maybe a couple of million for the founders and return maybe 1.2, 1.5x to their investors, maybe $1 on the dollar invested. And 1 in 10 will grow on the hockey sticks and make $100, $200, $300 million exit and return 20x on invested capital. It is at the early stage when the company has just started scaling its revenue. It's absolutely impossible to predict which ones are going to be the winners. The story about, I looked the entrepreneur in the eye and I saw $1 billion. That is, of course, a magical, mystical thing. that is the thing of the past. The statistics are in. It just does not happen, right? So the only way to meaningfully invest in early stage startups is to invest by portfolio. The minimum portfolio needs to be 10 companies. We'll try to deploy into the first deployments into 20, 30 companies. And then we watch them as they grow, and we double down and triple down in the portfolio leaders and the stars of the portfolio. And then to keep our proportion of shares in the growing companies. So when they are exiting at $300 million, we keep our 5% share or keep our 10% share, 10% in that startup. That's the statistics of after they've raised professional venture investment.
Okay.
In terms of startups that are created as an idea that get to venture investment, that's probably another 1 in 10.
Okay.
So, yeah, 1 in 100. You know what? No. Take it back. 1 in 1,000. 1 in 10 will get to angel investment.
Mm-hmm.
Of those who have raised angel investment, 1 in 10 will get to venture investment. And of those who raised venture investment, 1 in 10 will get to a meaningful exit. So 1 in 1,000.
Okay. So it's, lots of ideas out there, right?
Lots of ideas out there. Of course, technologies are, a lot of the startup ideas are the same.
Mm-hmm.
A lot of technology are the same. And so the question is not necessarily about who has the better technology. The question is rather of who has better commercial execution.
Mm-hmm.
Even that is not a given. So even that, the usual story of we're emerging on a journey in the market where nobody knows, absolutely nobody can predict what will happen 5 years from now. The technology changes so fast, regulation changes so fast, client preferences change so fast. You have a very general vector of idea of how things are going to pan out. So therefore, the only way to test your ideas is to do. There's absolutely no, beyond 2 weeks of thinking, there's absolutely no way of thinking, planning, creating financial plans and budgets. All of that is completely out of the window, right? The only way to see if you can do something is do. And once you've arrived at the idea that the only way to achieve something is do, then you immediately know when the best time to start doing is. It's today. It's right now. The longer you think and debate and research, the longer you are depriving yourself of the opportunity to build something new for the world. Same with us as investors. There's absolutely no way to figure out ahead of time who is the winner. So therefore, find the ones who look like winners, create a portfolio of as many as possible, work with them to bring them to $100 million exit, and maybe if we're very, very lucky, we will bring one to a $10 billion IPO and all get crazy rich. This is a gamble. This is not a manageable. We cannot manage to $1 billion exit. You can only hope for $1 billion exit.
So you've only been in Gibraltar for a day, and as you've seen, we are big advocates for tech in specific industries. But what is really happening in Silicon Valley right now?
What is happening in Silicon Valley right now? Silicon Valley accounts for about a half of the global venture market. It's about 120 billion a year industry, which sounds like a lot. It's actually nothing, rounding difference compared to America's GDP. However, it's quite a sizable market, mostly condensed around San Francisco and a little bit in New York. The valley of death is definitely there. There is a very vibrant and very rich market in angel investors, first generation rich people, including tech people, who allocate $1-2 million of their portfolio and write $50,000 checks to support various entrepreneurs. There is, as you read in the newspapers every day, there is a vast industry of billion-dollar venture funds, small P, Bain, Goldman Sachs, all these people, out-of-town people, SoftBank, Russian oligarchs, name it, who are prepared to write $300 million checks. And there's precious little in between. So the early stage Series C, Series A is right now the valley of death for technological startups in California as much as it is anywhere else in the world. The overall financial market is looking like it's going to be a little more full of turmoil, a little more risk averse in the next 2 years. What this will mean is that venture allocations to venture will be even smaller. So far they're growing. 2019 will be the historical year for venture investment. 2020 will probably go back. What this means is all of the large fund will want to invest in the same winners. So the large rounds, the crazy valuations, all of that is going to continue. While the Series A and the Series C companies who are just beginning their commercialization will see a significant decrease in money available to them. So what this means for entrepreneurs is get to the revenue soon.
Mm-hmm.
What this means for us as an investors is we will only invest, and we already do that, we only invest in the ones that have recurring revenues, or deep pocket investors who have pockets deep enough to carry the startups through the next couple of years, or preferably both.
So tell us, what of your portfolio companies that you're now handling with Viaduct Ventures are you most excited about, and what is it that they do?
Mm-hmm. With your permission, because this is a public
Mm-hmm.
meeting, I will omit the specific names.
Yes, no
but
worries.
we do have in our portfolio the industrial IoT company.
Okay.
The leading Fortune 500 industrial companies have been deploying various gadgets in their production facilities for about 7-8 years now. So everything has a gadget, and all this information gets gathered and gets put on an Oracle platform, and from there, nothing is done. It is not being used at all. Right? So every large corporation has its own data scientists and engineers trying to figure